Hi, my name is Jim Blazek. I'm an attorney with the Estate Planning Law Group of Blazek and Gregg. All we do is estate planning. Our motto is better planning made easy. I have a couple of tips today to help you do better planning for your loved ones. Cost basis rules. With the estate tax exemptions being so high, over $11 million, a lot of focus is given today on minimizing capital gains tax. We want to show our clients how to minimize capital gains tax for their loved ones. Truth is, a lot of taxes are avoidable if we will only do the right kind of planning. Let's talk about a couple simple rules. Let's say John buys stock worth $10,000. That is John's cost basis in the stock. Fast forward, and the stock is worth $50,000. If John makes a gift of this stock to his son, child 1, John's cost basis of $10,000 carries over to the recipient. Gifted property has a carryover cost basis. The donor's cost basis carries over to the recipient. So now if child 1 sells that stock for $50,000, child 1 pays tax on gain of $40,000 because John's cost basis carried over to the recipient. Another cost basis rule that's important to remember is what happens when the owner passes away. How do we determine cost basis? Inherited property has a adjusted cost basis. The cost basis in the hands of your family becomes what it was worth on the day the owner passed away. So John holds this stock till he dies and it's worth $50,000. The new cost basis for his family is $50,000. They can sell the stock for $50,000 and pay no capital gains tax. So it's important to have appreciated property inherited, and in so doing, you avoid a lot of capital gains tax. That's a very important rule. Now let's put those rules together for married couples. We see a lot of clients come to us and they have a lot of assets in joint tenancy. Well, joint tenancy ownership of capital assets between husbands and wives can lead to a lot of unnecessary capital gains tax. I'll show you how that works. Let's say John and Sue invest $10,000 into a joint account. $10,000, which means John's half is worth $5,000, Sue's half is worth $5,000. Let's fast forward. This is a wonderful account. It becomes worth $100,000 at John's death. Well, again, whatever you own at time of death, whatever's includable in your estate for tax purposes, receives a cost basis adjustment. So John's half is now worth $50,000. But Sue's cost basis and her half is still $5,000 because she didn't pass away. So the total value of the account is $100,000, but the cost basis to the surviving joint owner is $55,000. John's half of 50 plus her half originally of 5, $55,000 cost basis. So if it's sold, she has a gain of $45,000, and if we ballpark the capital gains tax at about a third, we have about $15,000 tax. So we show our clients how to avoid a lot of this capital gains tax by separating the accounts, not having a joint ownership account, instead having John money and Sue money. So now John, at his death, his whole account gets a step up in cost basis. Sue can sell Sue can sell his account after his death for $50,000 as fair market value and pay no capital gains tax. Very important rule for married couples to be aware of. Generally speaking, joint ownership of capital assets between married couples is almost always a bad idea. For more information on how to do a better plan, give our office a call. Thanks for visiting our site. All the best.